How to get your banker to loan more. Brought to you by CFO On Demand from Fitzpatrick, Bongiovanni, and Kelly, CPAs. Please support our sponsor. This month's feature sponsor is Bank of America. We'll be hearing more about them later in the presentation. I am your presenter, Lou Bongiovanni from CFO On Demand, and welcome and glad to have you joining our presentation. Let's start with the webinar objectives. How successful business owners learn to speak the banker's language. How best to structure a loan request. How to work within the lending process. And last, 7 ways to get your banker to loan more. So first, speaking the banker's language. Successful business owners understand that working with a bank or a lender involves a relationship. This is something that gets fostered over a period of time. An important part of the relationship is knowing the players involved in it. Many successful business owners understand that they're more successful in getting loans by incorporating not only the banker, but the CPA and the lawyer in the process. If this is a transaction in which a business or a piece of real estate is purchased, usually the lawyer is involved on the legal side of that transaction. The CPA is involved in doing the financial analytics to see if this is a viable and profitable undertaking. And lastly, the banker is involved in the financing of the transaction to make sure that the capital is there for it to work. Another way of enhancing the relationship with the banker is to meet with them not only formally when there's a transaction or a renewal of a line of credit, but also informally, so that you get to learn more about the banker as a person. They get to learn about you and the business a little bit more informally off the records. That might be in, let's say, a Chamber of Commerce outing or a golf outing or something of that nature. It always helps to foster a relationship, and hopefully it's a long relationship there with the banker by meeting informally at times, not just formally. The lending process is not just an isolated transaction. It's really a stream of transactions, most likely, over a long-term relationship. That's how successful business owners view borrowing money and the whole lending process. One thing also that you want to keep in mind is you want to discuss the current as well as prospective plans when you're meeting with the banker, giving them a heads up, letting them know where your thought process is and the goals of the company is always helpful for them to be your advocate down the line when you need the financing. Giving them more time is always to your benefit. The 4 C's are a good way of getting an understanding of the foundation of how the bankers look at commercial lending. They have obviously a strict rules as far as regulations there, but these 4 C's help guide that process and help successful business owners borrow more from the banks than people who are not as successful or don't do it as often. So the 4 C's are cash flow, collateral, credit worthiness, and cash in the deal. And I'll go over them quickly as a little refresher. So the first 2 are cash flow and collateral. So cash flow is, will the cash flow from the activity, once the money is lended, be able to support being able to repay the loan? Collateral is looking at the business as well as personal assets, and are they enough to secure the loan and give the lender comfort that if something goes wrong or disastrously wrong, that there is enough collateral in order to be able to be liquidated and satisfy the loan. This is also done in the form of personal guarantees. The next 2 C's are credit worthiness and cash in the deal. banks realize they're not just lending to a separate business entity, they're really lending to individuals who have a business entity. So looking at the credit worthiness of just the business or just the individual is really short-sighted. They look at both together, and they want to make sure that ideally they're both of good credit in order to feel comfortable lending. But if one's of not as good credit as the other, that's going to be a red flag that needs to be addressed in a language that you need to focus on in order to get more out of the lending process. Cash in the deal gives the banks comfort that the owner is putting their own capital at risk here for the venture, and the bank feels that, well, if the owner is confident enough in the venture in order to risk their own capital, that gives them more comfort that to lend money and risk the bank's capital towards it. Many owners will say some such things such as they have sweat equity in it, and that's fine and expected, obviously, but real equity is also important in order to give the banks comfortable that you understand what's needed of them and really understand the language and the philosophy of lending. Let's talk next about how to structure the loan request. And before we get into the specifics, there are a couple of points I want to make. One is you want to be clear on the nature of the loan when communicating your request. You want to be able to explain what type of debt you're requesting to borrow. And I'll use the term productive debt versus unproductive debt. That is a term that you see quite a bit here. So productive debt would be something such as buying an asset that's income producing, maybe a piece of equipment or a vehicle there, or a business that's going to be income producing. Unproductive debt is seen as maybe paying down credit card debt or helping with the slow collection of accounts receivable. Unproductive debt might also be viewed as money borrowed for buying out another shareholder or a partner. So the unproductive debt does not have an immediate return on the investment, and sometimes it doesn't have any return on the investment. Well, banks will look at these two types of loans in different ways and have a different criteria. They might be more interested and give more preferable terms to a productive debt as opposed to an unproductive debt. But if the unproductive debt request is part of a long-term relationship, they may be more up to make that kind of loan because they're looking at it as a longer-term relationship and a stream of loans during the history of the relationship. You want to make sure that the loan objectives align with the banks, the loan objectives of the borrower, so that the borrower knows why they're borrowing the money, the banks are clear on it, and the bank's objectives as far as lending and the owners are well known. There are also influencers that I want to point out in structuring the loan process. So those influencers are managing the risk profile. That's your business as far as personal. They'll look at how risky the loan would be. This would be that the banks would view that and then determine what the term should be, how high the interest rate needs to be, how long of the term of the loan should be. So that is something as far as managing the risk of that particular loan with that particular company, but they look at that overall with the business owner's personal risk because the business owner might have other businesses that they're involved in. So they have to take a global look at the risk and the amount of exposure. That also ties in with the amount of credit that the bank is comfortable extending to a particular individual. And again, an individual might have multiple businesses going on with their own assets, but the amount of credit that is available is finite. So you want to make sure that if you're looking to borrow, that you're borrowing for the right reason and you're expending that finite credit to get the most out of the bank and using it for the best that you can to make the business more profitable. You want to, the bottom line is understand why you need the financing. Is it for maybe some past missteps that happened in the company that you're trying to play catch up on, or is this for a futuristic endeavor that you want to take, whether it's a new product line or a new location or acquiring a competitor. Just understand the nature of the financing, because that'll tie into how the bank assesses the risk, and that'll also determine the appetite that that particular bank might have for the transaction. Now, the actual structuring of the loan request. You want to have a packet put together that is comprehensive and touches a few bases. Now, in the digital age, what I'm finding is that tends to come in more piecemeal than it did before. Before, when it was more paper, you put a nice packet together. It was all about an inch or two thick because you have multiple years of financial statements or tax returns, and it was all in one piece and got presented as such. Now it's more piecemeal. You're maybe emailing the bank the financial statements, then the tax returns come in separately, and then there might be a loan application, then narrative, and then projections, and they're all coming in kind of piecemeal. And you're really relying on the banker or the loan officer here to piece that all together for your benefit. And that sometimes can be lost in translation. So, having said that, you want to provide the historical and prospective financials. Cash flow analysis is king, and that's really important, but you want to make sure that that is put together in a nice comprehensive way. You also want to include a narrative of sorts of how you're going to use the funds. So it might be apparent, hey, I'm buying this business, I'm going to use the funds for it. But again, you're presenting, or your loan officer is presenting to a board. They don't have the benefit of getting the specifics, so you want to make that as easy and as clear as possible. You also want to provide a narrative as to why you're borrowing, as opposed to, let's say, putting your own money into the deal, and how leveraging the transaction makes most sense for the success of the company and the likelihood of the loan to be repaid. Some other points with structure here. You want to focus on the presentation of the analysis. As I pointed out before, it's coming in piecemeal. When the loan officer presents, he has to put it all together. He or she has to put it all together, and that makes it kind of difficult. So you might want to be mindful of how this will look in the actual presentation. As far as the loan process, you want to let the banker know who is on your team internally, whether your controller is actively involved or a full charge bookkeeper, as well as externally, whether you have a CFO on demand as the services we provide on your team, or a lawyer. You want them to know who's going to be involved in helping move not only this transaction along, but beyond that. That has more weight than most people realize. You also want to address your backup plans to mitigate any losses. So if things don't go as planned, how are you able to pull back or scale back and mitigate against the losses, allowing you to maybe regroup and redirect? It's rare that you come up with a plan and you say completely on script there. You tend to be calling audibles or things of that nature along the way, and they want to know that there's some flexibility, because things don't always go as planned, whether you're a small or a big company. Banks know that all too well. As far as the process that we're going to talk about, we just talked about putting the package together. Now, as far as the process, it's important to know the players on the bank side in the process, and this may vary from bank to bank depending on the size and the structure of it, and also the size of your request. And incidentally, with the size of the request, over 75% of commercial loan bank requests are for $250,000 or less. So most people, or most banks, are accustomed to dealing with those smaller size loans there, so they get many of them. And you want to make sure that you can distinguish the validity of yours as opposed to another type of loan request that might be inferior and therefore rejected. So in the banks, you're dealing with relationship managers. This is the person who is designed to have fun. he or she is the one who's going out golfing, going to different dinners and luncheons, and really just fostering the relationship with existing clients as well as with prospective clients. So they're the ones that you get the free tickets to the ball games for and those type of things. And you need to understand that person's role. That person's role is just to foster the relationship. Once you have a relationship, that person is there just to maintain it. They're not going to be key in the actual loan request. Next is the loan officer. This person is really designed to be your advocate. This person is going to be your voice in presenting to the final loan committee in order to get credit. We'll talk a little bit more about that role because that role is critical here. Next is the credit officer or the analyst. This person is the one who ultimately decides whether or not that the loan request is credit worthy and should be made. So they're the person who makes the final decision, and the business owner does not interact with that person. So really you're working through the loan officer to get your story to that. And then there's a need for a loan approval board there, which is, depending on the size of the loan, it might need to go to a small or larger board. And again, they receive the presentation from the loan officer and makes the decision as far as how much or if to make the loan. So these are the key players involved on the bank side in the loan process. I did want to focus on the loan officer for a minute because that person is your advocate and the critical person in the role is in obtaining a loan. They're your liaison between the bank and the borrower. They're also designed to be your financing advisor for current and future plans. So they're going to give you direction. They're going to give you a feel for what the bank's appetite is for a particular loan or in a particular industry. You're going to get a lot of insights from this particular individual. Now, this individual will have their own strengths and weaknesses. And if one of their weaknesses is in being able to present your particular loan package in a way, because let's say there's some unique aspects of it, you want to make sure that you help them along in the process. And we'll touch more about that later on in the presentation. But it's really important that you understand the loan officer, have a very good relationship with that person, because that person is really going to be the key. And many times, business owners will switch banks just because the loan officer moved to another bank. So that's how key that role could be. If you have found yourself a good loan officer, that person could be very helpful in the process. Now, the lending process, talking more about how to work the bank's lending process. You want to get a full understanding of the process. We just talked about putting a presentation together and the people in the roles. Now we're going to kind of talk a little bit about the process itself. You want to get a full understanding. And again, this comes from the loan officer. He or she is the one who's going to be educating you and coaching you along. You also want to understand what challenges does the bank have in making this particular loan. Is there a challenge with the outside economy overall, or the local economy, or your industry, or in the players that you have as far as your particular company? So risk could be at all different levels, and you want to get a feel from the loan officer exactly how these factors will impact the chances of you getting the financing you need. I talked about helping the loan officer. Here is one example. Is you want to include a detailed narrative for the loan committee, understanding that the credit officer, the loan committee, is not going to be a group that you're going to talk to directly, but they're the ones who are going to make the ultimate decision. So you have a chance to give them your side of the story spoken with your words, and it's important that you take advantage of that, especially in this day and age when, again, things happen very often over the computer, and you lose that personal touch and communication. So let's talk next about the 7 ways your banker can loan more money to you. Number 1 is you want to meet periodically. As I pointed out before, this is a relationship, not just a transaction. You want to make sure that the loan officer in this particular case, or the relationship manager initially, understands your business. Invite them to the location of your business. Let them understand how things are going, maybe things you've tried in the past, and have them understand that and listen a lot, because they might be dealing with many other businesses in your same industry and could give you some insights as far as generally what some businesses have done right and wrong over the years, and maybe you can learn from them. And most importantly, in this discussion, when you're talking with the banker, you don't want to just give them the good news. You want to give them the bad news, and you want to give them that early on in the process so they know upfront what they're dealing with. They don't want to be surprised as your advocate when presenting to a loan committee or a credit officer. So you want to make sure that you're at full disclosure with them. Number two, you want to provide a narrative or a video. I kind of touched on that once or twice already here. Because the loan officer isn't the one who's ultimately making the credit decision, you want your voice to be heard in the best light it could. And now some people do that in the form of a narrative, but I've also seen people do that in the form of a video. There's nothing wrong. Again, in this digital age, you can do that. You can have a little video on why you want to have the loan and why you're seeking financing from it. You can really get a connection with a credit officer or loan committee by using video. Number three, remember the 4 C's: the cash flow, the collateral, credit, and cash in the deal. It's important to understand the language, because that language is the foundation of the whole lending process. That if you take your eye off of one of those C's, most likely it's going to be to your detriment, or it's going to set you back. And one thing with entrepreneurs, they are very forward thinking. They want to expand, they want to grow, and they do not like hearing no when they have their heart set on certain ideas. As long as you can work within the parameters of the lending process and understand these 4 C's and how they play, and make sure that you get through that before you as a business owner get too excited about a transaction, then you'll stay grounded and you move forward. There's been plenty of examples in in history where credit being too loose has really maybe been good in the short term as far as businesses, but has really hurt the economy overall with a lack of trust in the lending process. In 2008 was an example of it. And then credit got incredibly tight for a few years subsequent, and now has gotten back looser, but not quite as bad as it was. So there's an ebb and flow to it, and you want to make sure that you discuss the risks and the rewards. Number 4 is provide bank with prospective analysis. Again, you're trying to have them see into the future with you as a result of this loan. So the best way to do that is not only in financials, but graphs help, spreadsheets, things of that nature. Bring it to life, because not everyone relates to just pure spreadsheets. If you could tell the story with using different mediums here, the better. You want to be realistic with your assumptions for sure. And you always want to link it to the past, because bankers get most comfortable when they can understand the starting point and it's accurate, and then you show them how it's going to progress. They're much more inclined to want to bank with you. And again, they want to show that there's a history of working with them, so that you have a solid history and hopefully a consistent history, and therefore they'll be more inclined to believe your predictions of the future. If your history has been unpredictable or you've been surprised by it, they're going to be less likely to buy into a future plan because of that. Number 5 is understand the bank's lending process, what each management's role is. We kind of talked about that in the beginning of the presentation, how the loan committee is structured. You want to know how many people are on that, and what's their criteria and what's involved. If you want to know who's on the loan committee, that's information that may be helpful for you, then you could ask for that. And you want to understand the credit assessment process, that's managing risk, and how that impacts interest rates. Sometimes it just might be better to pay a higher interest rate on a particular transaction, because that'll solidify you getting the amount that you want, and gives the loan committee the comfort that they're being rewarded for the risk they're taking with you on this particular venture. Sometimes you're going to get really good terms with it, and sometimes not so good terms. Sometimes the banks can handle it, can have some wiggle room. They always seem to have wiggle room. Sometimes it's just bad timing in the overall economy. All those internal and external factors need to be weighed when you're talking about the lending process. And you want to leverage the bank's network. The bank deals, like Bank of America has, tens of thousands of banking customers worldwide here. So they deal with many complementary services or businesses to your particular business. They maybe have an opportunity to be a referral source with some of their clients. You could also deal with your suppliers and customers. And you always want to be respectfully confidential. Obviously, if you're asking the bank for suggestions or advice or introductions, the bank needs to be comfortable that anything that's discussed between you and the banker, or you and this person they're being introduced, is highly confidential. The banks want to lend money. They want to foster relationships amongst their customers. So networking means a lot to them, as long as the lender understands kind of the rules of the game and plays within them. That can be very, very beneficial for you. And last, know when to shop around. If there's not a good fit with your particular bank, it may be the loan officer is just not being as good of an advocate for you, or the bank's philosophies and towards your particular industry or area is just not where it needs to be. That's the time to maybe explore other options as far as who's the best fit for you as far as a loan officer in the bank. You don't only want to look at costs, you want to look at relationships. Banks are going through many mergers and acquisitions over the years, so that could all come into play as it relates to your decision and the dynamics of your relationship with a bank and how much they're willing to lend you in a particular time. So in a quick recap, the 7 ways to get your banker to loan more. So 1, you want to meet periodically. 2, provide a narrative or video so that your voice is heard to the actual group that makes the lending decisions. Remember the 4 C's when borrowing. Provide the bank with prospective analysis. Help them see that futuristic picture, especially relying on the current picture that they do know. Understand the bank's lending process and exactly what it takes to get through the credit, the underwriting process, the credit, and the eventual, term sheet and commitment letters. And you want to leverage the bank's network as best you can, and know when to shop around if it's just not a good fit for you. At CFO On Demand, we look to assist our clients in the lending process. We're very active in this role as outsourced CFOs for small businesses. This is a very critical role that we play, not only in maintaining lines of credit and borrowings for clients from year to year, but also when they're looking to expand. And many of our clients often look to expand, and understanding how critical the lending role is, we find that our role is very important with the financial analysis part. And on the left, you see companies before where the financial reporting is done by the internal staff, but no real support with the financial analysis, and that drags the business owner back down, where the diagram on the right, when we're involved in helping with the financial analysis, that helps convert the business owner from just a pure operator to more of a strategist, and that gives them a clear advantage over their competitors. Here are some of our upcoming webinars. We appreciate you joining us for this one. Our next one is CFO and Human Resources Perfect Together. There's a strong trend of that happening more and more in small and medium-sized companies, and we'll talk more about that. And then you have the next few months of webinars as well. If you like this webinar, we encourage you to share it with other people and to continue to support us. And now a word from our featured sponsor, which is Bank of America.
Morning. My name is Brian Jolakowski, and I'm a member of the business banking team at Bank of America Merrill Lynch. As a strategic partner with our clients, KPIs are an essential for every business. We want to share with you a resource we have available that helps entrepreneurs benchmark their business. The Peer Profiler compares your business to an industry peer group. The data is drawn from the bank's 50,000 plus clients. This analysis can provide business owners some fresh insights to help improve performance. To give you a glimpse of how this works, we've prepared a sensitivity analysis of a company's working capital position. If you were to shift your trading accounts from current levels to your peer group average, you could free up $699,000 in cash. Assuming a 5% borrowing rate, this would add $35,000 to your bottom line. The Peer Profiler has a wide range of uses and is just one example of how Bank of America Merrill Lynch works with our clients to help them optimize performance. We are proud to be a sponsor of the CFO On Demand web series and would welcome the opportunity to conduct an analysis of your business.